Hey everybody, it's Big Mike. So as always, I want to thank you for being here today, and obviously I want to thank Al Brooks. This is the third time that Al has been on BMT for a webinar presentation, and this time he has 3 brand new books out that you can get on Amazon. They're all in his favorite topic, which is trading price action. They deal with the 3 behaviors of the market, which is trading ranges, trends, and reversals. So Al has kind of put together some new material for the webinar today, and he'll go over those subjects, plus he's going to give you some chart analysis of the S&P 500, of the euro, of oil, gold, and some major stocks like Apple, Goldman, Google, and etc. All right, guys, so as you have questions, just type them into the question box. They will only be visible to myself and to Al. I'm sure that Al, as always, will do his best to answer everyone's questions. The webinar is being recorded. If for some reason you've missed something, you can always go back and watch the recording, which I will post probably sometime tomorrow. Also, at the end of today's webinar, we will be giving away 5 autographed copies of your choice of any of Al Brooks' new books. So at the end, be sure to stay tuned after the Q&A, and I will start the quiz questions that Al has come up with to give away those books. Now, I do want to tell you right now that these quiz questions have been written by Al, and they do directly refer to the material that he is going to cover during the webinar. So you're going to want to pay very close attention. You might want to take a screenshot of some of his charts, as he's going over each of the instruments. Maybe take a screenshot so you can refer back to that, because I can see the questions now, and I think that that will be of benefit to you later, so you're forewarned. All right, guys, give me 1 second, and I will turn things over to Al.
So I bought back all of my short S&P futures contracts and listened to the radio as I was driving into work. And no one knew how far the market was falling. No one knew what the price of anything was. The quote screens. Nobody could keep up with anything. But it turns out if I kept my positions and exited on the close, I would have made $400,000 that day, which was far more than I made doing eye surgery that day. Anyway, I learned a lot from that. I've learned a lot from many experiences. At the time, I was aware of this trend line on the Dow, this pink trend line, and I saw that the market appeared to be finding support on that line. But the media was talking about the Dow just being at the start of something huge. No one was really saying that the market was at the end of something huge. No one was saying that this is just a one-day event. But I learned a lesson that trend lines mean something, and that trend line on the Dow back there in 1987. The market overshot it and then slowly channeled up and eventually broke out when the Republicans took over Congress in 1994, broke out to the upside. I'm always looking at swing lows and swing highs, and I'm always drawing trend lines and trend channel lines. Since the Dow fell through that trend line, I then used the low of that sell-off to create another trend line, and it seemed like it was a meaningless trend line after 94 when the market broke to the upside. But here, 22 years later, when the market crashed in 08 and 09, it poked a little bit below the trend line and found buyers again. And that's just an example of how trend lines are important, even on the monthly chart, and even 20 years after the points, the data points to create the trend line happen. On the monthly, this is the cash S&P index chart right here. It's the same as the Dow. Anyway, what's going on with the monthly S&P cash index? When I look at the chart, what I see is sideways. It went up into 2000, then it went down, then it went up, and then it went down, and we've been going up since 2009. So what I see is a trading range. Looks like it's been going on probably since 1997. So about 13, 14 years. And in a trading range, I always immediately think buy low, sell high, scalp. On a monthly chart, scalp means something entirely different from scalping on a 5-minute chart. But the basic idea of buy low, sell high, I think is valid. It's in a trading range. It's easy to look at the 5-minute chart and think it's a bull. It's easy to look at a 1-minute chart and you might see a bull trend at one point and a bear trend at another point. On the monthly chart, what I see is a sideways market for many, many years, 13, 14 years. And we're in the top half of the trading range. So if I were placing trades on the monthly chart, I would start to look for opportunities to short. I want to hold on a second. Let me pause this for a second. I want to see if I have one other screen. Yep. Okay. This is the Dow monthly chart. It's the same thing as the. This is the Dow monthly chart, and it's the same thing as the E-mini. Again, 14-year trading range. You can argue that this high over here in 07 was a higher high major trend reversal. I don't have the trend line drawn in, but you had a bull trend, a strong break of the bull trend, and then a rally to a higher high. And whenever that happens, traders are looking for a reversal, and it usually leads to 2 legs sideways to down. We had 1 leg down in 08 and 09, and I think traders are looking for a second leg down. Now that we've rallied so high back up into the trading range, I think traders are starting to think that the market may get above the 07 highs and create a new high. If it does, what will happen? I don't know if the market will get all the way up to this trend channel line. However, I do think that the odds of the market getting above the all-time highs are increasing. If the market does get above the all-time high and turns down, it will have 3 pushes up, one over here in 2000, and then one over here, 2007, and then a third push up to a new high, maybe sometime in the next year or 2 or 3. If it reverses down, those green lines show that it could be reversing down from an expanding triangle top. Yes, it would be a higher high. Yes, it would be a failed breakout above the top of a trading range. But to me, as a trader, I would be looking at it more as an expanding triangle top. Let me move this line over here. So in terms of an expanding triangle, I'm looking for 5 legs. Triangles always have at least 5 legs. Always has at least 3 in one direction. So we went up, up, and if we go up again and reverse down, that would be a pretty reliable major trend reversal. On these crashes, like in 1987 and then again in 2009, the market just crashes. It races down to a support level. In this case, both crashes raced down to a monthly trend line. And I view that as simply a cell vacuum test of support. Once the market starts getting closer and closer to the support level, if you're a bull, you're going to start to think that, hey, the market's going to hit that support level. So why buy at 8,000 when I can buy at that trend line, down there at 7,000 or below 7,000? So the bulls lose interest in buying They want to wait until the market gets down to the support, preferably breaks through the support and reverses up. The bears think the same thing. The bears start thinking as the market's crashing, hey, this is falling fast. There's a trend line below. I bet it's going to get down to that trend line. So I'm going to keep shorting until it gets there. Once it gets there, I'll stop shorting, and I'll probably buy back my shorts and take profits. And because both the bulls and the bears think the market is going to get down to the support, and the bulls stop buying until it gets there, and the bears keep selling until it gets there, the market oftentimes accelerates down to support. So when it starts getting near support, a lot of times it accelerates and collapses. And then when it gets to support, the bears buy back their shorts for a profit, and the bulls aggressively buy. And the result is a spike bottom, like in '87 and like what took place here in 2008, 2009. So I refer to that as a sell vacuum. In terms of the abbreviations that you see on the chart, I didn't want to write out everything. But if you go to my website, brookspriceaction.com, and you look on the left-hand side, there's a link to the abbreviations, and it'll explain all of this. Okay, I've already talked about the cash index. I'm closing out the windows after I talk about that. E-mini monthly, okay. What do I see? To me, I see the market went up and down and up and down and up. That's a trading range. So the the monthly E-mini chart, just like the Dow and the cash index, are in a trading range. We've had a sharp rally, but it's a sharp rally. It's a bull leg within a trading range. I don't think this is a bull trend on the monthly chart. It can be a bull trend on a smaller time frame chart, but on the chart in front of me, I see a trading range, and I see that the market is in a bull leg. It had a bear leg over here in 2002 and 2003, and everyone thought the world was going to end. And then it had a strong bull leg, and everyone thought the market was going to go to all-time highs. And then it had a strong bear leg, and everyone thought the world was going to enter a depression. And now it has a strong bull leg, and everyone thinks the market's going to go to all-time highs again. And that's just the way trading ranges work. They have many attempts to break out of the downside. 80% of the attempts fail. And they have many attempts to break out of the upside, and 80% of those attempts fail. And on the monthly charts of the stock index, the stock indices, and the E-mini futures, it's just a trading range. We're racing toward the top, but it's simply racing toward the top of a trading range. This could also be viewed as a large bear channel. We're making lower lows and lower highs, so we're still within a bear channel. On the weekly chart of the E-mini and the Dow and the cash index, what does the market look like? Basically sideways. We went up some, we went down, we went up, so it's basically a 4-year trading range. We're in a bull leg within the trading range on the weekly chart. We've been rallying for several years now, but the rally is not all that strong on the weekly chart. Pretty good sized pullbacks here and over here. Might be forming a triangle, might be forming a double top with the 2011 highs. But the weekly chart, to me, as I look at it, I'm not all that impressed. To hear people on Fast Money talk, the market seems like it's going to be going up forever. They bring on fundamental analysts who have projections way above where we are now. That's always the case. Whenever the market's going up, they always find analysts who have projections that are far above where the market is, and the projections are never hit. When the market is falling, they always put bearish analysts on who have targets far below the market, and those targets never get hit. Anyway, so we're either in a triangle or a 4-year trading range, and over the past 6 months or so, we're rallying, and it might end up being a wedge rally that leads to a double top, and then a sell-off test of the low back in 2011. And if it breaks to the downside, then the market might have a measured move down. But right now, it's a 4-year trading range, and then there's a smaller 1-year trading range, and we're getting near the top of it. So for me, I would rather be looking to sell up here based on the weekly chart. Daily chart on the E-mini trading range. We went up and down and up and down. This trading range that we had back here last year, August, September, it was very volatile, multiple big reversals, and it was after a huge bear spike. I thought it was likely to be the final flag in the bear trend, and I talked about that repeatedly in my room, that I thought that any downside breakout of that trading range would get bought, and that the market would reverse up and probably have 2 legs sideways to up. We had a very strong leg up in October, and a sell-off in November, and then we're currently in another leg up. And this could be the extent of it. It could simply be 2 legs up. Trading ranges often have 2-legged moves. We had 2 big legs down, July to October, and this could simply be 2 legs up, testing the high of the trading range around 1350, forming a double top, and then the market turning down. So we had the final flag, and then we had a higher low major trend reversal. The rally beginning in October was a bull spike. The pullback into November was the start of a channel. That channel began with another bull spike, and then a pullback into December, and then we've been in a tight channel since then. We're right at a leg 1 equals leg 2 move based upon the November bull spike, and for leg 1, leg 2 move based upon the rally to October, that would take us up to the 1370 area, just above the old high. It looks like we're going to come up to the 1350 area, and traders will start to wonder about the possibility of a double top. Right now, bull leg within a larger trading range, we're getting near the top of the bull leg. So, I'm going to start looking for opportunities to short. We're channeling up, so and channels can go very, very far. Look back here in 2010, beginning 2011, the market looked very similar to the way it does right here. It's in a very tight channel. Traders are always trying to pick tops, but most attempts to pick tops in channels fail. What's happening is every time the market dips below the low of the prior bar, strong bulls are overwhelming the bears. The bears see the market going below the low of the prior bar as a sell signal. The bulls see it as an opportunity to buy at a discount. And because the bulls are stronger, a channel is a type of trend. The market just keeps grinding higher. So, what are the institutions doing? The profitable institutions, instead of selling below the market, below the low of the prior bar, they're buying. So in channels, traders are buying below the lows of prior bars. If they get an occasional bull reversal bar like that, they might buy above it. So daily, weekly, monthly chart on the stock market. To me, we're near the top of a trading range. I don't know how much higher we can go, but the odds are, even if we do break out to all-time highs, that there will be sellers up there, because most breakouts of trading ranges fail. And if we get above the all-time highs and reverse down on the monthly charts, it'll be a large expanding triangle. Notes, I think, are especially interesting. Let me put up the monthly notes. You can see a wedge shape, and you can see a very strong 2-bar bull pattern here, and we're currently in the 3rd push up. To me, that's a bull spike in 2008, and this is the 3rd push. So this is a spike in channel, and it has a wedge shape starting both in 08 and starting back here in 03. So I think that the notes are on the verge of a multi-year top. It hasn't triggered yet, but I do think notes are topping out. And when they turn down, as a guideline, I expect 10 bars, 2 legs. I just throw that phrase out all the time when I'm looking for an opposite move that's more than just a small pullback. It could be far more than 10 bars. It could be 20 or 30 bars. It could be far more than 2 legs. We could come all the way back down here to the '08 lows over the next several years. But I think we're very close to a major top in the notes, which means interest rates will probably go up. This is climactic behavior. If you look at what took place in '07, we had 6, 7, 8 bars without a pullback. That's unsustainable. That's climactic behavior. And then here in '08, we had 2 very large bull trends. In 2010, 5, 6 bars without a pullback, more unsustainable behavior. Over here, 2011, pretty much vertical. So we've had a series of buy climaxes without much of a correction in between. And when the market has 3 or 4 consecutive buy climaxes, it usually is followed by a correction that is far deeper and lasts for far more bars than what people think is reasonable. If you look at the pullback here in 11, it found support at the top of the spike over here at the beginning of '09. So to me, that's a gap, and gaps often lead to measured moves. Strong bull spikes like we had in '08 often lead to measured moves. And the market is very close to that measured move projection. Notes are very good at respecting measured moves. If you trade them intraday, you'll see that a lot of the moves end to the tick at measured move projections up and down. And that's true as well for higher time frame charts. And we're very close to that measured move target. It's possible that this month is the high. That this little inside bar a couple of months ago might be a small final flag that could trigger the reversal down. A wedge is a type of a channel, one in which the trend line and the trend channel line, rather than being parallel, they're convergent. We tried to break above the wedge back here in August and failed. Next month we turned back down. We're trying to break again above the wedge here in December. And January, it looks like we're failing again. If the market fails a couple times, breaking out of the top of a bull wedge or a bull channel, it usually then has to test the bottom of the channel. So let's say this month, January, ends up as a bear reversal bar. It would be a second entry short signal, and the first target would be the nearest support level, which probably will end up being the moving average, possibly this high back here in 2010. And then the next target would be the trend line. The moving average is above the trend line, so it has to get to the moving average first. When it hits it, it probably will be above this high from 2010. So the first target would be the moving average, and then the next support below that might be the trend line, might be that high. Ultimate target would be 2 legs down at a minimum, and probably all the way to the bottom of the wedge, which would be this low back here in '09. And the market will try to double bottom there probably, and then try to rally again, form a right shoulder, head and shoulders top, and then it could break to the downside and come all the way back down here. But over the next several years, to me, it looks like interest rates are going higher, and pretty much relentlessly higher for several years. I can't be sure of this, but I can be 60% sure, maybe 70% sure. The top has not triggered. We have not reversed down yet, so it's still in the bull trend. But I think the odds are that sometime soon we're going to have a very big reversal in interest rates with the bonds and notes falling for several years and interest rates going up for several years. Weekly chart on the notes, where the wedge is less clear here. It's more of a channel. Possible final flag, this little 3-bar pullback. This could be the final flag in the bull trend. The sell setup to me is not something that I would short, but we could get a strong bear breakout. I'd like to see a strong sell setup. Sometimes the market will turn down without one. If it does, it usually does it with a very large bear trend bar. So for me, to start thinking about shorting on the weekly chart, I'd like to see either a very strong bear reversal bar, which we don't have, or a very big bear bar, preferably 2 or 3 of them in a row, which we don't yet have. We're still trending up. We're near a couple measured move targets, one based on the height of this bear channel, another one based on the height of this spike. So I think we probably will go a little bit higher, but once we do, if we get a reversal down there, especially if we get a very strong reversal, it could be the start of a multi-year sell-off in the notes. Daily chart, the height of this spike I could have used. I could have used this. I probably should have used this for the top of the projection. And we're just shy of that. It's possible if this wedge has triggered. We have a spike up here, and 3 pushes up, 1, 2, 3. So a spike and then a wedge top. We have a larger spike over here, and this could be simply the channel from that spike. Still not a clear top. On the daily chart, I do think that was a reasonable short, based on being close to the measured move target, and based on having a spike here in October, and then 3 pushes up, so a spike and then a wedge. So I do think the daily chart is on a short. We've had 4 consecutive bear bars, so if the market goes above last week's high, probably will be more sellers than buyers. So we'll probably have a second leg sideways to down. Let me open another desktop. Okay, now I got to change. Okay, I'm hoping everybody can see this. I think I just switched the desktop for the webinar. If Mike, if you can't see this, either call me or send me an email, or just talk to me in the room. This is the Forex for the euro versus the dollar, and monthly chart. 2 very strong legs up, but we were up sharply here in 07 and then down extremely sharply. So to me, that's a buy climax. And whenever the market goes up big and then down big, to me, that means big confusion. Both the bulls and the bears have strong arguments. Big confusion to me means trading range. And I said it back at the time that I thought big up, big down meant big confusion and trading range. And we've been in a trading range now for about 4 years. So what's going on in a trading range? And to me, buy low, sell high, scalp. I don't care what they say in Money in Motion. To me, we're near the bottom of a trading range on the monthly chart. So to me, we're in an area where I'd rather be looking to buy than to sell on the euro. On the weekly chart, what do you see? Is it a bull trend? Is it a bear trend? Is it a trading range? It's a trading range. We've had several rallies. We've had several sell-offs. The sell-off back here in '08, tremendous momentum, and I'm sure everyone thought the market was going to fall further. The rally in '09, very strong. I'm sure everyone thought it was going to a new high. In 2010, very strong sell-off, breakout to a new low. I'm sure the money in motion traders were talking about some big move down. That's not the way markets work. When the market's in a trading range, it has very strong bear spikes that look like there's going to be a big breakout. But most of the time, the breakout fails and the market reverses. It has very strong rallies, like over here, and everyone thinks that the market's going to break out to the upside. But that's not how trading ranges work. They have very strong rallies, buy vacuums, testing the top. The price then gets vacuumed to the bottom. At the bottom, the bulls come in, the bears take profits. At the top, the bears take profits. The bulls take profits, and the bears come in. And eventually, the market breaks out, but most breakout attempts fail. This sell-off, money in motion, they've been talking about how bearish the euro is. To me, it's bearish, but it's a bear leg within a trading range, which means I think we're going to rally. Daily chart on the euro versus the dollar. We've had several spikes down. They're numbered 1, 2, 3, 4, in several ways to draw channels. To me, what's been going on over the past several months is a spike down here at bar 3, and then a very tight channel. We've broken above the top of the channel. The top of the channel is a trend line, so the market's trying to reverse trend, but the breakout above the channel is not a new trend. It's a breakout. The trend needs higher highs and higher lows, and we don't have either yet. So far, this is just a breakout of a bear channel, and not yet a major trend reversal. If we get a pullback sometime over the next 5 or 10 bars, 5 or 10 days, and then we set up a higher low buy, that would be a major trend reversal. That doesn't mean that the market would then become a new trend, a bull trend. Major trend reversal is really kind of a bad term because I think it makes traders think that the market is going to enter a trend in the opposite direction. Sometimes it does. More often, it evolves. So from a bear trend, it evolves into a trading range. The trading range can have a very strong bull leg, and it might end up as a trend. But what I look for with a major trend reversal is a swing trade in the new direction. So if we do come down and get a higher low in the euro, and then the market starts to turn up, to me that would be a buy and a swing trade, and it could go very far. It could go up to the top of the spike, up to the top of the channel, around 138. Don't know, but I would feel confident buying and swinging it up. I mentioned consecutive buy climaxes being unsustainable. Consecutive sell climaxes are unsustainable. Every large trend bar or series of trend bars is a sell climax. So we had a couple bars here. We had one here, and then we had another one over here, over here, over here, over here. That's climactic behavior. And if the market doesn't correct much, it builds up tension. And when the correction finally comes, it usually is much higher and lasts for far more bars than what traders think is likely. And we've had a series of sell climaxes within this channel. So I think that when the market ultimately rallies, the rally will last a lot longer than people think. Just look back here. We had a couple bull trend bars here, a couple more here, and then 4 or 5, 6 in a row here, and then a couple here, a couple here. That's unsustainable behavior. So when the correction finally comes, it usually will last longer and have more bars than what people think. Why is that? Think of it from a bull perspective. Strong bulls look for strong spikes to exit. So if you're a really strong bull and you took profits up here, right, after riding it up, for several months, are you looking to buy again 2 bars later, 3 bars later? Just a little bit lower? Are you thinking that, I rode this thing up for a long time, it's way overdone, it's probably going to correct for at least a couple of very large legs. I'm not going to buy again until 10, 20, 30 bars, and until we've had 2 very clear legs at a minimum. That's what the institutions are doing. That's what they're thinking. So once you've had these consecutive buy climaxes and the market starts to turn down, the strongest bulls are not going to buy again until after the market has corrected a lot. So that's why the market can correct for a long time, because it takes a long time before the strong bulls are willing to come in again. And the strong bears know that, so they know that the market's going to have probably at least a couple legs down, so they're willing to short rallies. And that's what happens. You end up with a trading range. This was a lower high, major trend reversal. There was a bull trend, a break below the trend line, and then a lower high, and it resulted in a trading range, not a bear trend. Ultimately, it broke to the downside. But most traders would have viewed the move after that lower high major trend reversal as a 3-month trading range. Likewise, we're breaking to the upside here above the trend line, and if we pull back and then start to turn up again, yes, major trend reversal. But until then, it's simply a break above the trend line, and it could end up being a broader bear channel. Gold, I'm always amused by listening to gold traders on television, and what amuses me is that they don't trade on logic, they trade on emotion. They always see the gold market as bullish, no matter what the gold market is doing. If the market is down for 10 years, it's bullish. It's a buy because it's underpriced. If it's going up, it's a buy because it's in a strong bull trend. So, when I see them on television, Peter Schiff is a good example. They come up with all of these arguments, but they made the same arguments when gold was dropping. So there are some people who are perma bulls. They're always bullish in gold, and I don't know why. Probably because it's a precious metal and people make jewelry out of it, and it has historical significance. It's been, basically a type of money, since the beginning of time. So maybe there's an emotional appeal. However, I think it prevents them from being objective in their analysis. So here's the GLD chart, which is the ETF for gold. And what do I see? I see a bull channel, and it broke to the upside sharply to the area of a measured move target, and then turned down sharply. Big up, big down, big confusion, trading range. So I'm not seeing this as a great buying opportunity. When I'm looking at this monthly chart of the GLD, I think we're probably in a trading range, and it probably will last several years. So buy low, sell high, scalp. Again, there's a gap over here. You can see how this pullback did not reach the breakout point, so it's a potential gap. We went a little bit above the projection, the measured move. But to me, we've had consecutive buy climaxes, many spikes. Here are 4 or 5 bull bars. Here are 3 bull bars, 2 very, very large bull bars. To me, the strongest bulls, when they see a bull trend going up for 10, 20, 30, 40 bars, and then it has the 2 biggest bull bars of the entire trend, smart traders say, wow, what a gift. I'm going to take my profits, and I'm going to step aside and wait for 10, 20, 30, 40 bars before I look to buy again. And I think that's what took place in that buy climax last year. And I think the strongest bulls will not look to buy for many bars and until the market falls much further than just half the height of one bar. So on the monthly chart, I see a breakout above a bull channel, a reversal back down, and consecutive buy climaxes. And I think the odds are we're going to go sideways to down for many bars. How many bars? 10, 20, 30 bars. Weekly chart, bull channel, a strong breakout above the top of the channel, and then a reversal back down. Big up, big down, big confusion, trading range likely. The bulls can look at this and say 2 legs down to the bottom of the channel, to the trend line. So a high 2 buy setup. And I can see that argument. Personally, I would not take that weekly buy. I think the move down was strong enough. We had 2 strong legs down. I think there's a pretty good chance we'll have a 3rd leg down. Also, a pretty good chance that we'll correct much further down after such an extreme buy climax. So I think gold probably has more to go on the downside on the weekly chart, and I would not be buying this as a high 2. Daily chart, strong move up, double top, strong move down, big up, big down, big confusion, trading range likely. It's possible that this is the end of the correction on the daily chart. We've had 2 legs down, so it's a large high 2 buy. Good looking bull reversal bar there, so that's good for the bulls. But we're near the trend channel line, and there'll be sellers there. And what I don't know is whether the market will fall below the December low and form a wedge bull flag, or whether it will form a higher low and then have a second leg up and double top with November. So for me, on the daily chart, it's not as clear as the monthly chart. Monthly chart, I think trading range for many, many bars, a year or 2 or 3, like we saw on the Euro monthly chart, and like I expect we'll see on the monthly chart of the notes and bonds. On the daily chart, to me, trading range for 4 or 5 months. We're in the middle of the range. It can go either way. I suspect that the sell-offs in September and December were strong enough that we're probably going to have one more push down. Maybe it'll form a wedge bull flag, for a rally. But I think the market is going to have a hard time getting above the November highs. So I think daily chart, trading range, we might have seen the low. We may go one more push down and then turn up, and probably the November highs will be tough to break. So I think we'll be in a trading range between, who knows, 145 and 175, for many, many more months. Okay, let me switch screens again. Couple stocks that are pretty popular. Apple, we had a strong parabolic bull spike, and then a two-legged correction. It was a buy climax, 2 legs. That's a common type of correction. And then we had a spike up through here in 09, and since then we've had overlapping bars, prominent tails, some bare bodies. So the channel up is weaker, and it's becoming even weaker still the higher up we go. The bare bodies are becoming more prominent, and the tails are becoming more prominent. But we're still in a bull channel. However, consecutive buy climaxes here in 09, and then these 3 bull bars, and then this large bull bar, and then 4 more bull bars, and then another bull bar. Consecutive buy climaxes usually results in a larger correction. 10 bars, 2 legs, maybe 20 bars, 2 legs, maybe 30 bars, 2, 3, 4 legs. When the channel starts to get a lot of two-sided trading, it's usually in the process of evolving into a trading range. So right now, it looks like Apple probably will start to form a trading range, with the low maybe being the 300 low here. I don't know if we've seen the top yet, but I do know that based on this monthly chart, I would have no interest in buying up here. Based on this monthly chart, I'd rather be selling above bars than buying above bars. because I think that the channel is so two-sided that it will soon evolve into a trading range, and this is probably near the top of it. We're also around the measured move target. Maybe a micro double top, where the two highs are just a few bars apart. So if January turns into a bear reversal bar, it probably would be a reasonable short on the monthly chart. Weekly chart, the bull channel that's been going up forever. But look at the nature of this trading range. Very prominent bear bars starting to get some tails. So the two-sided trading is increasing here. So to me, this could end up being a double top, and we could test the 350 level at a minimum, maybe the 300 level. However, protracted bull channel, especially once it starts getting big bear bars and big tails on the tops of bars, it's becoming two-sided, and it's probably very close to evolving into a trading range. So, and we're near a measured move target. I don't know that we'll get there. We might not. But to me, and I would be not looking to buy near the top of the channel.
Yeah,
the channel looks like it's becoming more two-sided and evolving into a trading range.
Just so you know, Apple just reported they just crushed their earnings, and they're up over $30 after hours, trading at 451 right now.
Oh, that's cool.
So it's pretty much right there at that measured move.
It's getting close to that measured move and the top of the channel. But to me, I would rather only be looking to sell. So it'll be interesting to see, what happens over the next few days. A lot of times, markets will have very, very strong or very, very weak earnings, create large gaps, and then reverse. Let me just, well, I don't want to do that. I was going to point to Oracle as an example. But I'm afraid that I'll lose the stuff that I've written down over here. Anyway, so Apple, I can see it's up $24, up, and it's up at 451, 452, so it's somewhere up here off the top of the chart, near the top of the channel. But to me, we're starting to get increasingly two-sided in Apple, and I would not be buying breakouts. I would only be looking for shorts up there. However, just because it's at the trend channel line does not mean I would short. I would want some kind of reversal setup. Like we had this little double top over here. I thought that was a reasonable short, for a trade. We had a double top over here. You can see what's happening. When the market gets above a prior high, it's finding sellers. Above a prior high, it's finding sellers. Above a prior high, it tried to find sellers here, but obviously we're back up here now. I'd like to see what happens up near the top of the channel. I think the odds are it'll start to find sellers, but I don't know. I'm always open to anything. No matter how certain I am, I'm also, I'm rarely more than 60% certain on a daily, weekly, or monthly chart. And that means 40%, the market can do the exact opposite. When it does the exact opposite, I never get upset, because I realize 40% is a high probability. If somebody's shooting at me and they're not a good shot and they only have a 40% chance of hitting me, I'm going to be very respectful of that 40%. When I'm trading, I'm always very respectful of people who have the opposite opinion, because I'm rarely more than 60% certain, which means I'm at least 40% confident that the person taking the other side of my position is right and I'm wrong. So the other side is right often enough so that if I start getting evidence that I'm wrong, I just get out and take my loss and not worry about it. Bank of America, I think, has been interesting. We had a huge crash in 2008, 2009, and then a very strong bull spike, and then a weaker sell-off, 3 legs down, a wedge bull flag, either a double bottom or a higher low, potential major trend reversal in Bank of America. And you can draw a very steep trend line. We broke above it. We tested the moving average, and now we're testing the low. So when I look at the monthly chart of Bank of America, I see this as a higher low major trend reversal. First target will be the monthly moving average. It's also arguably an expanding triangle. 3 pushes down, 2 pushes up. Anyway, after a major trend reversal, a guideline, I'm looking for 10 bars, 2 legs, and at least a trading range. Daily chart, Bank of America, tight channel, kept hitting the line. A triangle at the bottom, maybe a wedge. You can call it a wedge, call it a triangle. Over here in November, you could have argued that this was a double bottom or a lower low major trend reversal after the break above that trend line. To me, that's too many bars down, too many bear bars, so I don't think that's a good buy. So I would wait for a second entry, and we got the second entry back here at around $5. And it's a third push down, a wedge or a triangle, and we've been rallying. I think this is the first leg up. We should get at least 2 legs up. So I think the odds are any pullback will be bought. I have one final slide, one final desktop. Okay, this is monthly USO, which is the ETF of crude oil. I've said many times, big up, big down, big confusion, trading range. Monthly chart, that's exactly what happened. Big up, big down, trading range around the moving average. And so monthly chart to me, we're in a trading range until we're not. And this could go on for years. Daily chart, it's also a trading range. You can see it went up a lot, it went down a lot. We had a spike down here in May, and then 3 or 4 pushes down. So basically a spike and a channel, and we're rallying up near the beginning of the channel, which is what usually happens with bear spike and channels. You get a bear spike and then a channel down. The market usually tests back near the beginning of the channel. The bears will try to create a double top there for a sell-off, and the bulls will want a breakout to the upside. Breakouts usually fail, so it's more likely that even if we do go above the highs of the past couple of months, that the market will find sellers somewhere, 41, 42, somewhere up in there for a push down. It may have a wedge shape, I don't know. But to me, this is a bull leg in a trading range, and we're near resistance, the beginning of the channel. So I think crude oil probably, if it does go higher, probably won't go much higher before it finds much more aggressive sellers. Netflix, to me, is interesting. This is the weekly Netflix chart. Very strong move. You can call it a spike and then a channel. Lots of bear bars, consecutive buy climaxes, very strong bull spikes all through it. It's going up too far, too fast. Unsustainable behavior. So chances are there will be a correction, 10 bars, 2 legs. Instead of 10 bars, 2 legs, the market just crashed. I remember last year when it was going up, I was several times in the room. I mentioned I don't understand it. Using Peter Lynch logic, the guy who did the Magellan Fund back in the 70s and 80s. If you see a product and you like it, it's probably the company's probably going to go up. If you see a product and you don't like it, the company is probably not going to make much money, and the stock is going to go down. I mentioned several times last year, many times. Sorry about that. Sorry about that. I mentioned many times last year that I was a subscriber to Netflix, and that right before they talked about raising rates, I canceled my subscription because I thought the product just wasn't good, and I didn't understand how the stock could be going up so sharply when the product just isn't that good. And apparently a lot of other people felt the same way. Hold on a second. Okay, sorry about that. So anyway, I'm just bringing this up as an example of Peter Lynch logic. You know, when it was going up, it didn't make sense. The chart itself didn't make sense, consecutive buy climaxes. The sell-off was far sharper than I thought it would be. And we may be in the process of setting up a major trend reversal here and pop up the daily chart. You know, we're breaking above the trend line. The market will probably test down and try to have another leg up. Maybe it'll form a wedge bear flag. I suspect that we're in the process of forming a major trend reversal and that there'll be buyers somewhere down in this area, around the 80 area, testing these highs. And the market probably will have at least one more leg up. All right, I covered what I wanted to cover. I just wanted to go over several of the major markets on monthly, weekly, and daily charts. Just talking about them the way that I look at them and the way that I'm looking for trades. I can see there's some questions. Let me take a look at questions. Okay. My French is not very good, so the first question I cannot answer. I'm hoping it's a nice thing. Okay, there's a comment, just GE. Let me pop up GE. I don't know if the question, if it's an exclamation or if it's a comment about General Electric. General Electric, strong bear sell-off starting in May, and then we had a strong bull spike up near the top of the channel, and then a pullback to a higher low. So this is probably a higher low major trend reversal. To me, we're right near the top of the channel, and until we break above this, this resistance area, I'm assuming that the market will stay in here. So I personally would not be interested in buying GE. Also, so many other stocks look so much stronger that I personally would not be buying it. Is it a long? Yes, it's a long, but I don't think it's all that strong. Okay, I'm just going through the questions, and there are a lot of comments. Is Al trading Apple? I do trade Apple a lot, but I'm not trading it right now. Let me just take a look at Apple. And let me put up the 24. Put up a 5-minute chart. A lot of times when it does these big pops up or down on earnings, you just get, okay, this is what I was talking about. Okay, so people looking at the price chart, the quotes, will say, wow, it's up 25 bucks. Yeah, but look what it did. I don't know if that is a bad price. Let me put up a 1-minute chart and see. So what happened when the market gapped up? It looks like it found a lot of sellers. And I think that's in part because of what I was saying, where it is on the daily, weekly, and monthly chart. It's an area where I'd rather be a seller than a buyer. So I think that's interesting. Strong bull spike, but it may be a failed breakout. Getting back to questions. What is your opinion about Murray Math lines in relation to price action and how prices are action around them? to be honest, I really haven't paid much attention to Murray math lines, so I really can't comment on it. Okay, I'm reading through a list of questions. A lot of them are just, hi, how are you doing type comments. So I'm deleting them one by one. Does the artificial increase in money supply lead it to establish a new high? When you're talking about it, I don't know if you're talking about notes or the Forex or indices. And I never think in terms of fundamentals. I just think about price action, because I think all the fundamentals are incorporated in price action. One thing that always amuses me is on money in motion, how when the market is, let me just put up the euro. I'm always amused by money in motion. They'll see the market going down, and they'll say, "Oh, here's a fundamental. There's a meeting next week, or something's going to happen, and therefore the market's going to go down." And oh, look, the chart's in a bear channel, so that even supports my view. To me, that is so ridiculous, and they do that all the time. They're trading technically, and they're trying to come up with fundamental reasons, I think, to make them sound smart. But I think it has nothing to do with their analysis. They make it sound like the euro is based upon one little fundamental thing that they're pointing to one meeting or one little some little thing, and that's not the way markets work at all. Major markets like the euro, they're being traded by governments, all the biggest banks in the world, all the biggest brokerage firms in the world, and they're not being traded for one reason. They're being traded for thousands of reasons. And to hear the people on Money in Motion point to one little reason as the mover of the market is ridiculous. To me, if the market's going down, I assume it'll keep going down. If it's going up, I assume it'll keep going up. They are right in their trades. For example, if it's in a bear channel, they're selling near the top of the channel. If it's in a bull channel, they're buying near the bottom of the channel. But their logic is irrelevant. What they're saying about the meetings and the fundamentals is ridiculous, and I would totally ignore it. But anyway, going back to your question about the artificial increase in money supply, I don't pay any attention to that. I wait to see how the institutions interpret it. And for every piece of fundamental information, there's a bearish and bullish interpretation. Some institutions take the bearish side, others take the bullish side. The chart shows me where most of the dollars are going. If the fundamental information comes out and the market goes higher, that means there are more dollars going into the bullish side, and that's what I want. That's what I want to do. I want to be bullish. I want to buy. If the market goes down based on the fundamental information, that means more dollars are on the sell side, and that means I want to sell. So I never pay attention to fundamentals. Okay, question about e-signal. I'm using e-signal data and did not have a downward trend on the monthly data, and I have a breakout on the weekly. I'm not sure which. Which sectors are expected to be the best performers in the next 3, 6 to 12 months. I don't trade sectors. I do pay attention to them, but I trade individual charts, so I don't pay attention to sectors. Okay, could you please point to the candle structure where you think the bulls may buy when the market drops again? Let me put up that. Let me switch to that E-mini chart. Okay, hang on. I'm going to open up some charts. Okay, when the bulls will buy again, there are monthly bulls, daily bulls, weekly bulls, 5-minute bulls, 60-minute bulls. There are all kinds of traders operating on all kinds of different time frames. On the daily chart, the market's in a bull channel, so traders will tend to take profits near the top of the channel, and aggressive traders will short near the top, and they will buy near the bottom of the channel. I don't have the bottom of the channel drawn in, but on the daily chart, people will look for support to buy, and that means the bottom of the channel. Next support would be the trend line. Next support would be, the moving average. Next support would be this lower trend line. Key support would be this resistance area. The market could not get above the 1260 area after many, many attempts, and then finally get above it. So resistance becomes support. So at some point in the next month or so, I assume we'll have a pullback to the 1260, 1265 area, and I assume support will hold. Don't use the wicks for measured moves on notes, and we are there at the move. Yeah, I always pay attention to the wicks or tails. 30-year bond market. Let me put up the bond market. I may be missing the questions because a lot of the questions are just a few words, and they're not. I understand people are trying to type questions quickly, but because there's not much information in many of the questions, I may not be able to understand them fully. Okay, 30-year. This is the 30-year bond daily, double top, spike, and trading range. To me, the dominant feature of this chart is the tight trading range between 140 and 145 or so, and I assume the market will stay there forever. And once I see evidence that I'm wrong, I'll trade it differently. But until I do, I'm going to trade it like a trading range: buy low, sell high, and scalp. So to me, we're near the bottom of the range, so I'd rather be looking for buying opportunities on the daily chart. If we break below 140 and have follow-through selling, then I'll start to think that the double top is beginning to control the market, and I'll look for shorting opportunities. But right now, I'm assuming that this tight trading range will continue, and that traders will continue to buy around 140 and continue to sell around 145.
Hey, Al, I've got a quick question for you. For
notes.
For people that are asking about indicators, maybe if I ask you this question, your answer will provide a little bit of clarity for them. So why do you use an EMA 20?
I'm sorry, are you talking to me, Mike?
Yeah, for people that were asking about indicators and such, I thought that maybe if you answered the question as to why you use an EMA 20, it might provide some clarity for people that are, asking about different indicators.
EMA 20. Okay. Yeah, to me, you don't have to use any moving average to be able to read a chart. Let me just knock this moving average off for a second. Okay. To me, the price action remains. I personally use a moving average because there are a lot of tricks that you can learn, and you can make money by using the moving average. And you don't have to use a 20-bar exponential moving average. I have one friend who uses a 9-bar simple moving average and a 30-bar simple moving average. I have another friend who uses a 10-bar simple moving average. I have another friend who uses a 30-bar weighted moving average. I don't think it matters which moving average you use as long as you learn how the market behaves around the moving average. I use the one that I use simply because I've used it for forever, and I think it works particularly well on the 5-minute chart. However, I don't have a problem with a person using any moving average as long as they, become familiar with how the market behaves near it. I don't have a problem with a person using any indicator, bands and oscillators or anything. I don't have a problem with a person using any time frame, any type of chart, chart based on tick volume or the number of shares. To me, the goal is to make money, and if you're able to do it consistently, I don't care how you're doing it. I'm going to respect what you're doing. I do what I do because it works for me, and I'm comfortable doing it. But there are lots of ways to trade, and if you've come up with some way that works for you, I think that's really cool. That's great. 10-year note, top of the channel. Channel top line has become support. I'm misunderstanding the question, because whenever I hear the top of a channel, I always think of it as resistance. Notes the next bubble to burst. I think that's true. Why are measured moves always up in an up trend, and why not play the counter trend sell? A measured move is, for example, here in notes, a measured move is just one of many types of resistance. Most resistance fail. Most of the time, the market just goes through the resistance and then goes up to another resistance level. And however, whenever the market turns, it always turns. Whenever a bull trend turns, it always turns down at resistance. Whenever a bear trend turns up, or whenever a pullback in a bull trend ends, it always turns up at support. So I'm always paying attention to support and resistance, and I'm watching to see how the market behaves when it gets there. And if there are a confluence of reasons for the market to turn, in other words, if there are multiple resistance levels right around the same price, sometimes I will sell with a limit order at that resistance level. Otherwise, since most resistance fails to stop the market, I usually wait for a reversal before I look to trade counter trend. Remember, the market has inertia. Trading ranges tend to continue forever. Most attempts to reverse or to break out will fail. Trends continue forever. Most attempts to reverse fail. So if you get a bull trend, most resistance above the market will fail to stop the trend. And a bear trend, most support will fail to support the trend. The market will just keep falling through one level after another. Okay, euro. Why is the drop in June and July not a spike that you counted on the chart? I don't have the chart with me, but to me, this is a spike over here in May. There's another spike here, another spike there, a much bigger spike here. It had a bull bar in it, but it's still basically a spike. Another spike here. Every trend bar is a breakout. Every trend bar is a climax. Every trend bar is a spike. Every trend bar is a gap. I don't want to go through all that, but there are. I have webinars on the website. If you look through them, I talk more about that. But to me, every trend bar is a spike, and you can look at any one of them. And whenever you see a trend bar, and it's getting follow through, I'm always looking at channels, and I'm always looking at measured moves. So I always treat them the same. Do you use the monthly, weekly, and daily charts of the big picture and trade on a smaller time frame chart like the 5-minute chart? When I'm trading on the 5-minute chart, most of my trades are based on the 5-minute, but I do pay attention to the 60-minute, much less attention to the daily, weekly, and monthly. You can be in a strong bull trend on the monthly chart and have incredibly strong bear trends on the 5-minute chart. So, I like paying attention to the big picture, but I don't place 5-minute trades based on the higher time frame, daily, weekly, and monthly charts. What do you mean by you are waiting for 2 legs? Let me try to find a reversal. Okay, well, I'll just use this as an example. Buy climax. When it corrects, I expect the market to make 2 pushes down, or 2 legs down. I define legs in my books, but a leg is just a small trend. On a smaller time frame chart, it could be a huge trend. On the 5-minute chart, these two bars on the daily chart are probably a huge bear trend. But anyway, to me, this is basically one move down here into May. Then we had a pullback, and the market will probably look for a second leg of about the same number of bars and the same number of points. And that's probably part of the reason why it found buyers here in July. It's about a measured move down. A leg 1 equals leg 2. So there's leg 1, and there's leg 2. Didn't quite get to the measured move, but that's what traders are. When I'm talking about 2 legs, I'm talking about 2 independent moves. A clear move down. You could say that this is already 2 legs down, but when it's basically within a channel, I think of it as 1 leg, and here's a second leg, and this is a second leg down, this is a second leg down, so you can view this as one complex leg down. So I know it's very subjective, but unfortunately, trading is very subjective. What do you think about the possibility of coming inflation in the U.S. dollar? Can this create skewed charts? Going back to what I was saying about Forex, to point to one variable as the controlling variable, I think, is not the right way to look at charts. That's what they do in Money in Motion. They point to one variable when there are probably 10 equally important variables, but they like to point to one as if it's that they're so smart that they figured out which is the one that all the traders in the world are going to focus on, and they figured it out before all those other smart traders have figured it out, and that the market will move in that direction because eventually those smart traders around the world will be as smart as the guys on television. That's not the way the markets work. There are many, many variables, and all the institutions are aware of all of the variables, and they attach different weights to different variables, and it's all a question of will most of the dollars think the market's going down, or most of them think it's going up, and you don't know until you look at the chart, and the chart tells you. The institutions cannot hide what they're doing. If most of the dollars believe the market's going down, the market will go down, and you'll see it, and it's better to look to sell. And if most of the dollars think the market's going up, the market will go up, and it's better to look to buy. And to me, I don't need to know the fundamentals, and I certainly don't need to know what somebody on television thinks the fundamentals mean. How do you establish your measured move targets? Unfortunately, I'm going to just tell you to refer to one of my articles in Futures Magazine. And also, I hate to say this, but the second of my 3 books talks a lot about how to create measured moves. The reason why I hate to say that is because I don't make much money off the books. So I hate to tell people, read the book, read my book. I don't care if nobody reads my book. I just put it out there, and if someone is interested, they can read it. But I do talk a lot about measured moves and how to calculate them. All right, can you talk about a high 2? I'll just use the euro right here as an example. Okay. A high 2 is a failed second attempt to go down in a bull trend. So here, the market tried to go down. First attempt up is a high 1. First time it went above the high of the prior bar, it's a high 1. Has a second attempt to go down here, and then it went above the high of the prior bar. So this is a high 2, and that's a buy signal. Here's a smaller one. Market went down on this bar, and then up and down on this bar, and tried to go up again. So that's a high 2 buy signal. Why do you use linear scaling when semi-log would be preferable in viewing long-term charts? That's because it's not preferable when viewing long-term charts. It's preferable if you pay attention to Robert Prechter, but to me, I understand your point, but I personally don't think it's preferable. I think the linear charts work just fine, especially when it comes to basic things like trend lines. And just look at the charts that I pointed out on the monthly Dow and the monthly S&P. The trend lines work just fine. Also, for the stock market, if you're talking about 30, 50, 100 years, and the market's going up 50-fold, 100-fold, 200-fold, if you don't use semi-log charts, you have tremendous distortion. The earlier data becomes pretty meaningless. You can increase the meaning by using the semi-log charts, but I don't bother. I tend to like to do everything the same way, and I tend to like to treat all the charts the same way. And the trend lines, the monthly trend lines work. That monthly trend line at the 2009 low, I sent that trend line to about 30 of my friends and relatives a week or so before the market bottomed, and I told them that I thought there was a very good chance that the market was going to bottom if it broke through the trend line and reversed up. And that was just on the linear chart. Okay, I can only stay for another minute or so. A lot of comments about Apple in the earnings report.
Hey, Al, I wanted to be sure and ask you one question. So I just spend just a minute.
Speak loud.
Yeah, speak just a minute about the three new books. I want to know, why did you choose those three particular subjects? Why are they three separate books? And did you or have you enjoyed the process of writing them? Just talk a little bit about the books.
Yeah, okay. Originally, it was one book, and it was going to be over 500,000 words. And, when I sent it to Wiley, that was a logistical problem. The books would have been, one book would have been about 5 inches thick. And, that just becomes a practical problem. If you're making a book and selling a book, if it's 5 inches thick, it's just unrealistic. So Wiley asked me to divide them into three and to try to divide them into some logical way. And that's why it went into three. And the three major things that the market does is, it trends, and it's either in a trend or a trading range, or it's transitioning from a trading range to a trend, which means breaking out or reversing, reversing from a trend into a trading range. So the transitioning. So I went with trends, trading range, and reversals. But within each book, I have a lot of other things. Like in the trading range book, the second of the three, I have a lot of information about the mathematics of trading and measured moves. In the first of the three books, I have a lot of information about channels, trend lines, basic price action analysis. And in the third of the three books, the book on reversals, I put a lot of information about reversals, yes, but also day trading in particular, and trading the first hour, and also what the best trades are, especially for somebody starting out. So I tried to be as helpful as I could with that. I'm losing my voice, and it's about 3 o'clock, so I'm going to stop now. And Mike, I appreciate the opportunity to be able to speak to everyone.
Sure, absolutely, and I appreciate you doing it as always, and I look forward to inviting you back in June for our 3-year anniversary. So I want to remind everyone that even though that Al is signing off, don't exit the webinar just yet, because we're going to give away 5 autographed books. So thank you, Al, and we'll see you around. Everybody else, stay put.
Okay, thanks, Mike. Thanks, everyone.
All right, guys, give me just 1 second. I need to bring up a screen. Okay. So I know that there were a lot of questions. There were almost 400 questions in today's webinar. So I know that a lot of you did not get a chance to get your question answered, but I do want to just say before we give away the 5 books that Al Brooks has 4 books now. Okay, so his first one on price action bar by bar, and then has 3 new ones. You can get all those on Amazon. And then he also has his own website. It's brookspriceaction.com. And there's a link on the thread on BMT, in the webinar thread. There's a link to that and to his books. And he does a daily webinar, I believe, where he talks about the market. So if you want to learn more about Al Brooks and his method, then that's the way to go. Okay, so I'm going to bring up his questions that he has emailed me. I know these are going to be a bit tough because we don't have charts to go with them. That's why I wanted to load this. So the first question is on the 10-year. Okay. Okay, so we're going to have to do the best we can without charts. Okay, here's the question. These are all generated by Al. For the monthly top in the 10-year notes, which is the most likely first downside target? And I'm going to give you 4 answers. I need you to type in one of the 4 things that I'm about to say. The EMA, the November 2011 high, the February 2011 low, or the bull trend. Okay, everyone stop, please. Stop typing. Stop. 500 people typing at the same time. It's very hard to find the first person, which is, okay, Bart S. Bart S., I need your BMT username, please. And you are the winner. The answer was EMA. Need your BMT username, and I'll contact you after the webinar is over to get you the book. Just type in your username, please. Okay, let me write that down. Okay. All right, and let's see, the second question. This is on the Dow, so let me bring up the Dow. Okay, doing the best we can here with the charts. Second question is, if the monthly Dow reaches an all-time high and reverses down, what is the best description of the top? And you need to choose from one of these 4. A failed breakout above a trading range high, a higher high, major trend reversal, an expanding triangle, or a wedge top. Okay, stop, please. Everyone stop, please. Just do me a favor. It's just flying off the screen. Okay, looking for here we go. Well, Bart, you actually got that one right too, but only 1 book per person, so congrats on being right. But I'm going to go to the second person that got it right, which is, here we go. Joe Faschetti, hope I got your name right. Joe, I need your BMT username, please. Just type your BMT username in, please, and I'll get you the book. Okay, great. The correct answer was an expanding triangle. Okay, third chart, he's looking at gold. Let's bring up gold. All right, the question is, why is it better to not buy the developing high 2, which is an ABC bull flag, in the monthly gold? choose from one of these four answers. The signal bar is more than $20 tall, so the risk is too great. The pullback did not yet reach the moving average. After a buy climax, the market is likely to correct for more than 5 bars, or trade silver instead, since the trader's equation is stronger because the reward is disproportionately large to the risk compared to gold. Okay. All right, I need everybody to stop typing, please. Everyone stop, please. All right, let me go back. Looking for the first person with the right answer. Okay. James Blunt, I need your BMT username, please. Type in your BMT username. All right, the correct answer was after a buy climax. All right, give me 1 second. Okay, let's go to question number 4, book number 4. Let's bring up the euro. Okay, James, I'll fix that. Hang on. Okay. Okay, question number 4. Which is not true of the euro? The daily chart is in a bear leg in a trading range. The weekly chart is in a bear channel. The daily chart has had a major trend reversal, or the monthly chart is in a bull flag. Okay, stop, please. Everyone, please stop. Okay, the correct answer was the daily chart has had a major trend reversal. Carl Koschik, hope I'm saying that correctly. Carl, please give me your BMT username. Okay, don't take long. Okay, there we go. Okay, and before we do the question number 5, I'm seeing a reminder from Robert that Al has another webinar tomorrow. I guess go to brookspriceaction.com, and he's doing a webinar tomorrow that's free. It's a reminder from Robert. Okay, last question. Question number 5. This is on Apple. Okay, thanks, Robert. Tomorrow's daily regular webinar will be free. So brookspriceaction.com for that. Okay, let's bring up Apple for book number 5. All right. Which is most true of Apple? The weekly chart is short below last week's low because it's a test to the top of the channel. The breakout on the daily chart is a new bull trend. The weekly chart is triggering a final flag, or the breakout on the daily chart is just a bull leg in a trading range. Okay, stop, please. Everyone, please stop. All right, the correct answer is the breakout on the daily chart is just a bull leg in a trading range. The winner is KS. KS, I need your BMT username, please. He was the first person. All right. Okay, got it. All right, guys, congratulations on winning the 5 books. I will contact you later today and get everything that I need. Get that info over to Al. He'll autograph them for you and send them out. Yeah, today, some people asking about the webinar. Today we had about 700 registrations, almost a full room, just shy of 500 people in the room. And the webinar was recorded, so I'll be posting that sometime tomorrow. If you guys have any other follow-up questions, you can put them in the BMT thread for this webinar, or if you want to talk to Al directly, then it's Brooks priceaction.com, and I will type that out for everybody. There it is. All right, guys. See everybody on the forum.